how many successful investors can you count? From Peter Lynch to Warren Buffett to Radhakrishan Damani to Rakesh Jhunjhunwala. आप मेरे को गिना देंगे ऐसे 10-15. You'll be able to easily count 10-15. But the moment I ask you how many successful traders do you know who made big money? So minimalism, I think, does not mean that you cut down all your expensive, or you downgrade from a 5-star to a 3-star, or from a fancy car to like a less fancy car. To me, I think minimalism means spending on. So I've been a financial advisor for well over 17 years, and during these 17 years I've come across many successful investors, and there's some common traits that I've noticed in most of them. I'm not going to talk about what books suggest are the common traits of successful investors or what it takes to be a successful investor. I'm going to talk about things that I've observed over years of meeting and observing successful investors. So one of the most important traits which investors have is the fact that they are focused and in love with fundamentals and valuations, and they always keep a margin of safety. One of the perfect examples for this I heard was recently I heard Ramdev Agarwal giving a presentation where he said, if in the year 2000 you had invested in Infosys, since 2000 till now, the earnings for Infosys have improved 25% year on year. But when you look at the stock price, it's only increased by 8% every year. And the reason for that is that in the year 2000, Infosys was available at a price to earnings multiple of about 190 or 200. Although today it's available at a price to earnings multiple of 23, and I think it's a very, very reasonably valued stock. You should definitely, it's why I'm saying this is because this is a stock which is in my portfolio. But the point is that when you buy something which is available at a reasonable valuation, you will invariably make money going forward if the company is good. But no matter how good the company, if you buy it at a very bad price, you would not make money going forward, no matter how well the business does, because it's going to always keep catching up to its valuation. If I were to explain this with numbers, a perfect example would be if you buy a stock for 100 rupees and it keeps growing at 18% per annum for the next 10 years. 10 years later, it'll end up at a price of about 523. But if after you buy at 100, it falls 20%, because it was overvalued, and then after that 20% fall it still keeps growing 18% for the next 10 years, the price at the end of 10 years would be 419. So 419 and 523, so that 20% gap you're never going to make if you end up buying something which is overvalued. Yes, of course, one of the things that you're looking at is, can the earnings improve? Can the price earnings multiple come down? Because earnings will keep improving going forward. That's there. But sometimes I see people buying stocks which are trading at such obnoxious valuations that no matter how much the earnings improve, you're not going to make that money back, because it's going to underperform for a long time despite improvement in earnings. So the point is, you have to focus on valuations when you're investing for a long term. Sometimes there's FOMO, you don't want to miss out. Everyone's buying stocks, markets are moving higher every day, and you end up buying stocks which have already moved up or are moving up aggressively, and that's where a lot of investors burn their fingers. This is something you have to avoid. Learn fundamentals, learn how valuations work. These days there's so many tools, even on a basic chat GPT, if you compare a 10-year average price earnings multiple with the current price earnings multiple of a company, you'll know fairly easily whether a company is overvalued or not, and then try to see whether the earnings can improve going forward or not. So one trait that I've seen in most successful investors is that they're all very patient. Now, whether they've developed it, they've inculcated it, or they're born with it, I don't know, but patience is the most important trait when it comes to investing. And what does patience really mean? I think patience in markets is not restricted to the ability to allocate money to stocks and then hold on to them. It equally applies to your ability to not do something foolish when things don't produce the desired results. So, patience is not buying and not selling, just staying still and doing nothing. And the ability to do nothing is, I think, the greatest ability one can develop. In case of investments, can you repeatedly ignore the noise and, avoid what media or news channels seem to be telling you what you keep reading on Twitter or Facebook or other social media outlets. It's easy to buy and sell. What's difficult is not to buy and not to sell. How long can you not buy a stock or not sell a stock? I think for me, the thumb rule is if you've not, forget about buying, because you buy stocks or you buy funds as and when you have money, which is okay. But the thumb rule is if in the last 18 months you've sold more than 3 times, then you're not going to be a very good investor. And this is irrespective of whether you need money for something or you just sell something to buy something else. If you're selling more than 3 times in 18 months, chances are that you need to develop a lot more patience than that. Now, by discipline, I mean, I see a lot of people coming up with all sorts of theories. The most common one that I've seen over the years is when traders say that, or first-time investors say, we trade only in fundamentally strong stocks. So that, even if the price does not appreciate or does not come to the level at which we've bought, we'll end up holding it and then it becomes our core portfolio. This is the fastest way to self-destruction. In trading, fundamentals should not matter, and in investing, your trading setups should not matter. So remember, the moment you start hoping that a stock price will recover and come back to the price at which you bought, what you're essentially doing is trading. You did not buy that stock with the intention of holding it for the long term. I knew a guy who was a very, very good trader. He was so disciplined that he would, break up, let's say if he's investing 100 rupees, he would break that up into 5 lots of 20 rupees each. And he would cut his losses in any position which falls below a strict stop loss that he would maintain. His discipline was extremely infectious. He used to have like a sticker on his laptop which said there is no hope, which I've copied and it's there on my Twitter. I really liked it. I asked him what that meant. He said, I try not to hope in the market. I don't trade on hope. I just trade on a setup. I trade on principles, which is extremely opposite, like completely opposite to how an investor would invest. He would not invest looking at where stock prices are going. In the short term, stock prices would move based on overall liquidity in the market, the sentiment, all sorts of things. But over a long term, they would move based on fundamentals and valuation. So, when you're investing, the thing that you have to keep in mind is you invest it and you give it at least 6 to 8 quarters before you look at the balance sheet, before you look at the company's fundamentals again and see if everything is moving as per plan. So, if you buy 10 stocks, maybe 3-4 of them will not perform, but so long as 6-7 of them are performing and performing well, you've done a very good job at investing. I've also noticed one more thing. I think the maximum wealth destruction that happens in investing is when people try to sell stocks that are doing well for them to average out or to buy stocks which are not doing well. So, they'll buy 3 stocks or 4 stocks. 2 of them start performing really well. They're up some 30-40%, and 2 of them are not performing well. They're down about 10, 15, 20, 30%. They'd sell their winners, take that money and invest it in stocks which are not performing well. And they want to balance their portfolio. 8 out of 10 times you will see that stocks that are not performing well will keep underperforming, and the stocks that you sold to average for these stocks, those stocks will keep running high. It's happened with me over the last many years. It repeatedly happens with everyone. It's a lesson which not many investors learn, which is why I think most investors make more money in mutual funds and investing in PMS products than investing themselves. I think I can confidently say 8 out of 10 people who are self-investors or DIY investors, if they're investing in funds and they're investing in stocks, if they see a 10-20 year track record, they would realize that they've made more money in their mutual fund portfolios than their stocks portfolio. The reason is fund houses often end up holding a lot of their stocks for a very long term. So when they start doing well, selling those stocks that time to average onto bad stocks is the worst thing you can do. Another thing I've noticed about successful investors is that they read a lot. And I don't mean reading newspapers or reading stuff on social media like Twitter or Instagram or Facebook. I mean reading some old classical text, and it may not necessarily or always be about investing. I've noticed that a lot of people who are very good with investments, they actually have this hobby of reading something classical, something old, something that's enriching. I guess it goes to patience and discipline, because invariably you'll see people who have this habit of reading, they tend to be a lot more patient and disciplined with what they do. Not always, but a lot of times I've seen that. And these days, you don't necessarily have to read books. These days there's a lot of these apps which read out these books to you. There's YouTube videos, YouTube audio. I personally, when I'm driving anywhere, I put something on which reads out books to me, and I think it's a great way to learn and put things into your mind. I learn a lot from that, and yes, it does keep me calm. It does keep me, it distracts me less. Oftentimes, I'll be honest, people ask me, what do you think about markets today? And I've not really looked at the markets, and I have no idea whether the markets are up or down that particular day, because, I don't look at markets every day. And the reason is because oftentimes I'm very engrossed in reading something, or I'm very engrossed in my thoughts about something that I'm trying to understand. And that, I think, is what keeps me distracted from the market, so I don't look at my stocks and their prices on a daily basis. So try to read a lot. So if 9 out of 10 traders lose money in the market, then the question is, who's making that money? Is it the balanced 10% traders, because 90% are losing money? Is it the 10% traders who make that money? Or is it the investors who invest for a long term? Well, the answer is not as simple as it may appear. It's not the balanced 10%. The answer really lies in how investors think versus how traders behave. Investors, or to invest or to make money with long-term investing, you need to have a base of capital. If you don't have a base of capital, don't get into the markets. The people who make most money in the markets are the ones who don't need money, because they can park away their money for a long, long time. This actually goes to the core of why investors mostly always win and why traders pretty much always lose in the markets. The reason is that investors don't come into the markets trying to make or meet their monthly expenses. While most of the traders I've seen, they come into the market with the intention of making money on a daily basis, or weekly or quarterly or monthly basis. Their intention is to earn their living or to make some money by trading the markets. Now, if you're a trader and you're getting into the market with the intention of making money so that you make that money and you compound it and you add it back to the stocks, then there's only one word for that. That's just pure plain stupidity. Because if you want to make money in the market and reinvest that money into stocks and you don't need that money, then you'd be much rather, you'd be better off investing, because over a longer term, all empirical evidence suggests that investors make a lot more money than traders. If I just ask you, how many successful investors can you count? From Peter Lynch to Warren Buffett to Radhakrishan Damani to Rakesh Jhunjhunwala, आप मेरे को गिना देंगे ऐसे 10-15. You'll be able to easily count 10-15. But the moment I ask you how many successful traders do you know who made big money, I don't think you'll be able to count many. In fact, the top 10 or top 50 or top 100 lists in the world are filled with investors, not really with traders. So to be a successful investor, what you need the most is first a base of capital, a base of money which you can park away with. So these days a lot of people say the first 1 crore is very important, and after that money starts compounding. I guess the reason is because even if you're making 14-15% on that 1 crore, then that means you're going to make 14-15 lakhs on your 1 crore if you can park it away for a long term. So get to that first 1 crore no matter what it takes, or whatever sum. It could be 50 lakhs for some, whatever sum you can do away with, and you don't need it for a long, long time. Unless you reach that point, don't get into stock markets. And finally, what I've noticed about successful investors, a trait which a lot of them seem to have in common is minimalism. They all believe in it. I think I have this habit, and I can talk from personal experience. There was a time when I did not have the kind of money I have today, and I remember listening to a lot of these investment gurus and reading a lot of books, and they all spoke about making a base of capital, and some of the books spoke about minimalism, and I started following it. I think the benefits of minimalism go beyond markets. And by minimalism, I don't mean that you don't spend money at all. What I mean is you spend money on things that you need the most and avoid spending money on things that you don't need. So I personally spend a lot of money on things that I like. I don't like to spend money on things which everyone seems to be buying is the new cool thing. To give you an example, I drive a BMW, but I have a very cheap phone. I do not go out every night. A few years back, I gave up on drinking, so I don't spend a lot of money on fancy restaurants or going out to nightclubs as I used to at one time. But if I travel, I want to stay at the nicest hotel. So minimalism, I think, does not mean that you cut down all your expensive, or you downgrade from a 5-star to a 3-star, or from a fancy car to like a less fancy car. To me, I think minimalism means spending on 2 places instead of 10. It's okay to spend a lot of money on the 2 places where you spend, but cut down your expenses on things which you don't need, at least in the initial years when you're trying to make a base of capital. Invariably, with whoever I meet who's successful as an investor, it becomes so much of a habit. Like, I have met people who have a portfolio more than 100 crores, but what they enjoy eating the most is, dal chawal or something which is home cooked. That's because, it's become more of a habit over the years. So this is something I've seen over and over again, whoever I meet who's successful. So if you want to practice minimalism, just always ask yourself before you buy something, why do I want this? And when it comes to your investing, your SIPs, your purchase in stocks, the answer will be fairly simple. I always put it like this. You invest for freedom, not really for status. You build wealth for peace, not to show off. You build wealth so that you can have peace, and you don't have to work at some point, or even if you're not working, you keep making a lot of money.